What's going on, everybody, and welcome back to Exploring Investments with Justin. And in today's video, I'm going to be covering why I finally decided to start a position in CLOUDFLARE. And in this video, I'm going to be talking about what my position in CLOUDFLARE is, and then I'll also be covering a table that I created that compares CLOUDFLARE's fundamentals to their biggest competitors and seeing how they stack up against them. And then the last thing we'll be talking about is why I actually started this position and what growth I see moving forward. So with that being said, let's not waste any more time. Let's jump right into the video. Be sure to hit that like and subscribe button because that does help out the YouTube channel a ton. And let's get right into it. Now, looking at my new position in CLOUDFLARE, I have 15 shares at an average cost of $43.52 for a total investment of $650. Now, right now, this is still a small position and only accounts for 3% of my total portfolio. So if we see any weakness in this stock, I will definitely be adding more to this position because I will be covering the explosive growth this company is seeing. And this is a company that has been growing revenues consistently at well over 50% each year. So you're definitely going to want to stick around for the whole video because I will be talking about why they're seeing this explosive growth and what they need to do to continue growing at this high rate. So what I'll be doing now is showing you how the fundamentals for CLOUDFLARE stacks up against their competitor. And be sure to let me know in the comments section if you guys would like me to create a table like this for my other stock update videos. Now, looking at this comparison, we can see that CLOUDFLARE and Zscaler are at similar stages of growth, while Fortinet is a more established, older company being founded in 2000, whereas CLOUDFLARE and Zscaler were both launched just over 10 years ago. So for this video, I'll mainly be comparing CLOUDFLARE and Zscaler when looking at this table. Now, the reason I finally decided to move forward with starting a position in CLOUDFLARE is because I feel that they are undervalued right now. And so as of Friday, they had a market cap of $12 billion, which is about 25% smaller than Zscaler's $16 billion market cap. Now, from a profitability standpoint, Zscaler is much closer to turning a profit with only a net loss of $70 million, whereas CLOUDFLARE is losing $120 million. But I do think CLOUDFLARE has more growth ahead of it and has more cash available to fund that growth. CLOUDFLARE has more than $1 billion in current assets, over $300 million in cash, and a current ratio of 9.4, while Zscaler has significantly more current liabilities with less cash and has a current ratio of 1.6. So even though they still have a good current ratio that's above 1, they'll still need to be more conservative with how they spend their money, whether that be hiring less employees, reducing their marketing budget, or slowing down research and development, which in turn hurts their ability to further improve their products. And it's not like their revenues are wildly different either. Zscaler only made $50 million more in the trailing 12 months than CLOUDFLARE. Now, both companies are trading at a pretty high premium right now, and this could be due to the future growth being priced in, since they both are expected to grow revenues by well over 30% in 2020 and 2021. But right now, CLOUDFLARE is almost 25% cheaper than Zscaler when looking at the price to sales. And in my opinion, I believe the two companies have similar fundamentals. So this is just a high-level overview of how CLOUDFLARE stacks up against their biggest competitor, Zscaler. And now what we'll be doing is we'll be getting into why I decided to start this position. And the first thing I want to note is the 77% gross margin that they're making on their revenue, because this allows them to keep $77 for every $100 in revenue that they earn, which can then be used on marketing or research and development. So I definitely really like the high gross margins when I'm considering future growth. Now, you can't grow without reinvesting your revenue into sales and marketing. And I actually do like the fact that they are almost twice as high as their long-term model. And this is because right now I want the company to grow as much as possible because that means my investment will grow with it. So I'm definitely happy to see that they're continuing to reinvest their revenue into sales and marketing. Now, we can see here that they've also been able to reduce their general and administrative expenses to just 17% of their revenue, which is almost half the 31% it was in 2018. Now, the last and most important number I want to cover is the operating margin. As of the end of Q2, they were at a negative 10% operating margin, which is significantly lower than the negative 30% they were at 2 years ago. And to me, this is a good sign because it shows me that they're slowly working towards their long-term goal of 20% plus operating margin. Now, if they were to have a negative 25 or negative 30% operating margin, then I would be a little bit more hesitant to invest because that would tell me that the leadership team team is not capable of executing on their plans. So the fact that they are working towards that 20% goal does tell me that the leadership team is executing on their long-term growth plans. And I think it's important for companies that are losing money to show investors not only what their path to profitability is, but how they're tracking on that plan. So to really prove my investment thesis surrounding future growth, I think it's important to look at the various metrics that really help understand the growth the company is seeing as a whole. So this first slide looks at revenue growth going all the way back to 2016. And what we can see is that they've consistently grown revenues by around 50% each year, and they actually recently raised full year revenue guidance to $400 million. Now at $400 million, that would give them 40% revenue growth year over year, and on top of that, they also grew revenues 48% quarter over quarter. So they are definitely showing no signs of slowing down that high revenue growth. Now, as I mentioned in my last Cloudflare stock analysis video, they get 100% of their revenue on a subscription-based model, which is a great revenue model because you can accurately estimate what your revenue is going to be each month, and this allows you to efficiently plan how you're going to spend that money. Now, the last thing I wanted to note from this slide is that 51% of their revenue comes from outside the United States, which means they're establishing themselves across the world. Now, if you're wondering where this ridiculous revenue is coming from, it's the large customer growth. In Q2, they grew the number of customers that accounted for at least $100,000 annually by 64% year over year. And if they want to get to a $20 or $30 billion market cap, they're going to need to consistently grow this number and bring in more revenue. So what we can see is that Cloudflare is growing their revenue and customer growth by more than 50% every single year. And this is definitely an investment that I'm super excited about because, like I said, I can see myself at least getting to a 2x or 3x on my investment over the next few years. So if we were to see any weakness and see the stock drop in value, this is one I would definitely be adding more to, especially considering it's only 3% of my portfolio. So it's really not that big overall, but it is still a decent sized position, and I will definitely be sure to keep you guys updated on it. So with that being said, guys, I just want to say thank you for watching. Be sure to let me know in the comment section what your thoughts are on Cloudflare, and be sure to hit that like and subscribe button because it does help support the YouTube channel a lot. And with that being said, guys, I will catch you on the next one.